Hello everyone, this is Stock Market Daily. Thank you for joining me today. It is June 8th, 2023. As always, this is not financial advice. Please don't copy my trading strategies because you will lose money. This is only for educational purposes. So, first things first, I want to apologize to anybody who was wondering where I went. I got a bunch of messages saying, hey, I don't see any more videos. I hope everything's all right. I hope that you didn't lose all your money, so on and so forth. So I was actually on vacation in Europe where we ended up having no cell phone service for a good portion of the trip because we were on a cruise ship. We had a lot of time. It was great. But I fully intended to make a video or two videos right before I left, letting everybody know that I am going to be taking off and I won't have, I'll be in a different time zone and I won't have internet service. So I will not be trading during that time. But unfortunately, with packing and kids' schools and graduation, time just got away from me and I was extremely tired and I just wasn't able to make the videos. It was super late by the time I was free for the past couple days right before the trip, and we were kind of scrambling to get ready. So I do apologize about that, but I haven't. I have. It's not like I stopped trading. I did trade even once while I was on vacation, and I did place trades to sync up to the day after I came back. So we came back on the 7th, which you see here. There's nothing here. This is today's, like I said, it's the 8th. So we came back yesterday, and all of my trades were pretty much expiring on this day. So any option that was open and was in the money, I think there was like one or two maybe at the most. All from May, I rolled into June 7th, and I opened up a bunch of new positions. So I had 4 on the put side, and I had 5 on the call side, and I essentially, I ended up having to roll majority of my, I had pretty much all of, except one option had to be rolled um, from the call side. So we, as everybody knows already, we had a major run up because of this debt ceiling news that came out, and the resolution was passed. So we ended up running up. I did not expect that. I did not think that was going to be that big. I knew it was going to be big news, but I thought it'd be buy the rumor, sell the news type of deal. Ended up being not that. And so my positions on the call side were trapped. So at the end of the day, yesterday, what I ended up doing, I just rolled the options into today. And one of those options I did not need to roll. So on the call side, this is today, the market is closed. You see that I opened up 3 new positions. Actually, one of them I ended up closing yesterday. It ended up in the money, and I rolled it to today just to collect more premium as I got back. And I actually opened up 2 of these right here. This one was rolled from yesterday. These two were opened today. They obviously closed out of the money. Now, everything on the call side was still in the money, and it is now rolled into the 9th. So here are the positions for tomorrow, and actually I have the credit, the long side is expiring tomorrow as well. So here we can show you that right now. Type in all, and here we go. Where's 9th? Right here. So here is my long side at 4,800, and I have now 4 positions that are in the money against that one, against this long side, which I had 5 of. Now, as you can see, I have more of these as well, and most of these are again on the call side, expiring on the 12th. So here's the long position at 4,600. Here's a short position. So I really, and same thing here and same thing here. So basically, I really did not expect for the market to go up as much as it did. And that is kind of the risk you take when you essentially enter the position that is so far out in time. And it was fairly out of the money. I think it was about 100 and something points, but obviously we ran up. I did collect a fair amount of premium for it, but I do believe that if I was doing zero DTE, that that possibly would not have happened. I would have obviously got trapped on some days. There were days that we ran up. I saw, a lot, over 1%. However, those are the next days, and then the market settle down and things like that. So there are ways to get out of that. But here I went and I put everything. I basically pretty much put everything on the call side, expecting this not to work out. And like I said, this would have been a completely different story had I been in town and been trading every day. But that's all right, because essentially what I'm going to do is I'm just going to continue rolling this out until we get out of it. If the market starts going up, then obviously it's going to be a little more difficult, but there are certain other things you can do, like take this one option and split it into 2 or 3. So let's say this is 8,000. If you divide this into 2 options, it'll be 4,000 per contract. Obviously, you're exposing yourself to more risk. However, you're moving up the strike price. So I think I'm going to do that with the one that's farthest in the money. So for example, this one right here is essentially that's a good candidate for it. Or maybe maybe this one. We just got to see which one makes more sense, because I am trying to capture as much of extrinsic value of the option as possible, which is right here. So the more you could capture of this, the better, because by the time of expiration, all of this is theoretically going to go to zero if the market doesn't change. And if that is paying for you to move up in strike price, then that's great. So let's say you sell 2 of these, that's $1,000 of extrinsic value, allows you to go up 10 points in strike price. So anyway, today the market did a very nice little melt up, and it looks like we're again testing the 4,300 level. We were so close over here on, what was it, Wednesday, and today it's Thursday. We ran up to that point again, but sold off. So I wonder if this is going to be kind of like what we were doing with 4,200, where we try to, we came to 4,200 multiple times, sold off, and essentially did that dance around that level for quite a long time. If that's going to be the case, I'm not worried about these positions at all. Essentially, just got to keep rolling them little by little every single day. Now, if the market starts moving past 4,300, then it's going to be a little bit of a problem. The other problem is that as the market is going up, kind of on the fast side, the VIX is going down, so the volatility is also going down, so it's going to be less and less premium. And as you could see that, the premium is dying on both sides, on the call side and on the put side. So it's becoming more and more difficult to play some of these trades, because you like to continue capturing as much premium as possible for your trade, but the premium is less and less, and you're exposing yourself to more and more risk, because the option, the price of the index is actually going up. So what you used to be buying, or let's say your exposure would be at 4,000 level. Now we're at 4,300. There's a big difference. That's $30,000 difference in the amount of collateral you have to put up. So but that's the situation we're in, so we have to kind of go along with it and learn from the market as it changes. So I'm glad to be back. I'll be doing these videos once again, and thank you for everybody's notifications and messages. So from this point on, you will see new videos coming along. Thanks a lot, and we'll see you tomorrow. Bye-bye.